Good morning,
Hello.
mums and dads, ladies and gentlemen, boys and girls. Andrew, Dan, Dornbush Partners. Welcome to the Dornbush download for this week as the phones are going nuts in the background. Don't know why, there's not really a lot going on.
No, second one for the year though. It goes quick, Andrew.
Flying along. And look, it's another interesting week, Dan.
It is, and it has been. Yeah.
You know, we spoke last week, Michael and I spoke about confession season. Well, confession season continues to be alive and well.
Yes.
Last week we spoke about Infomedia, just came out with some bad news. We've had a couple of others come out with some bad news. Cardno lost their CEO. So, you know, the market...
And it's interesting, Andrew, too, sorry to cut you off, but CSL this morning, you know, one vaccine, if it only has a 23% strike rate, you'd think that's pretty good, wouldn't you? Out of the whole range of products that CSL has, and their share market and their prices really hit. So.
But to be fair to CSL, or unfair to CSL, like their previous vaccines, the success rate was about 60%. So the CDC in the US said, look, hey, you know, you've previously been tracking at 60, you're now only 23. We're talking to the effectiveness of the flu vaccine, and the share price off 4%. Now, does the company need to lose 4% of value just because the flu vaccine isn't effective as in the past? And I think it really just shows the market jitters. I think it shows that people are looking for reasons to sell. And it doesn't really bode well, and without being the doom and gloom merchant, it doesn't really bode well for the share market for the year if that's sort of the negative outlook that we've started on. I was just reading before in the US market last year, they had no 5-day losing streaks at all. So over the 250 trading days, not one 5-day losing streak. They've had 2 since Christmas. So it really does show, plus of course what happened overnight with the Swiss basically just giving up on defending their franc. There is a lot more volatility out there at the moment, and as a consequence, I think from an investor's point of view, just need to be a little bit more cautious.
Yeah, so are we going to see Yellen come out and say some nice motherhood statement? Everything will look good in the US again.
So Dan's referring to the
Federal Reserve
chair, Janet Yellen. And interesting, you know, you talk about the US, you know, last week they had some jobs data came out, showed that 250,000 jobs created for the month, which was 3 million for the year. Most jobs created since 1999. So US unemployment rate now 5.6%. And using the US government's measure, that means they now have full employment. So basically everyone who wants a job should have a job. But the flip side to that was that they actually had wage deflation. So what that means in English is that people were actually getting paid less. So even though there was more jobs, they were getting paid less. And normally what occurs when you have full employment is people are getting paid more because there's these jobs out there and it's hard to try and fill the positions. And the thought process is that people who probably should have lost their job in the GFC under normal market pressures, employers did the right thing and went, no, we'll keep you going. But the flip side is now that things are normal again, is that the employers are going, well, look, I kept you going whilst things were bad. Now it's a bit of time for me. And so what that means from US interest rates, coming back to your comment about Yellen, is that even though unemployment is under control, you know, we're not seeing that wage pressure, which therefore interest rates, it's a blunt stick, it tries and bashes inflation. There's no inflation. And then you overlay that with the oil price, and I'm sure people are sick of us talking about the oil price, but you overlay it with the oil price.
It's so important in such a large economy, isn't it?
Well, it's a quasi-interest rate cut. I mean, we here in Toowoomba, we quite rightly bemoan what's going on with petrol prices or lack thereof, as April is nodding behind the camera there. But, you know, like in Sydney yesterday, 99 cents a litre for petrol. You know, 6 months ago it was $1.60. I mean, that's 60 cents a litre. What's an average car? 60 litres. That's a $36 a week, or call it round figures, $2,000 a year saving on petrol.
And generally that goes back into the economy, Andrew, doesn't it? You know, it's not like a rate cut where people keep the loan repayments going. They actually go and spend that.
Plus, it's insidious, if I can put it that way, because it's not just like petrol, you know, you and I driving a car, I walk everywhere, but more slowly, very slowly. But, you know, like you take Woolies and Coles as an example, and this vast continent and, you know, trucking all these goods everywhere, so the Cubes and the Tolls and all those guys, they're a big beneficiary of this falling oil price. Final thing on oil,
pass it on? That's
that's the big question. But the big concern about oil, so we're talking, there's all these positives. The big concern around oil, of course, is that it's deflationary. And the inflation and deflation, inflation prices going up, deflation is going down. You want inflation over deflation any day of the week. Doesn't seem to make a lot of sense, but if I make widgets and it costs me $100 to make a widget and I can only sell it for 80, I'm not going to be making widgets for long. So that's why central banks are really worried about deflation, because and it becomes a downward spiral. So that's why the share markets around the world are really volatile at the moment, because there's real concern about deflation that's going on.
So is that an argument then against another rate cut?
It is.
Yeah,
it is. And yet,
but we're really seeing it, aren't we? That the economists now calling for more rate cuts, and it's priced in. The longer term rates are really pricing in an under 2% cash rate. So,
because what is it at the moment?
Well, about the 3-year rate's about 2.45.
So basically, 0.5% interest rate cut coming in this year. Again, you're one of the 2.2 million self-funded retirees out there. How happy are you about that at the moment?
Another rate cut.
I mean, that's the last thing.
And that's a positive for the share market, though, Andrew, isn't it? The yields are in the banks and the other yielding stocks. So
Telstra, 13.5-year high. 13.5-year high for Telstra.
I saw a target on Telstra at about $6.65.
I have to say, and we'll wind up in a moment, but it's going to be really interesting to see what February profit reporting. I see Credit Suisse this morning are saying great results coming, 6,000 target for the All Ords by the end of the year.
Wow, that's a big call, isn't it?
And yet a lot of the other stuff you and I have been reading is saying if it makes 1% this year, it's going to be a big effort. So you have this huge divergence in views. You have all this volatility going on at the moment. No wonder clients are just sitting on the sideline going, I don't know, because we're frankly going, I don't know.
Waiting and seeing.
I think the key to it, Dan, and I'm sure you're the same, is that every time something's a bit cheap, you pick some of it up. And you're looking for something with a bit of dividend behind it, so that if you don't get any growth, you're going to do better than banks, better than bank interest. And really keep talking to us, and we'll have a better clarity as to what's going on at the end of February. But not a great start to the year.
No,
not a great start to the year.
It'll get better.
Till next week.
Bye.